Welcome to The Explainer. Today we're putting two absolute heavyweights of the fast food world under the microscope. We are going to look way past surface-level stock prices to spot true investment value. And more importantly, we're going to explain the hidden investment risk for shareholders that might just be lurking in your own portfolio right now. If you're ready to play financial detective, okay, let's dive into this. We're kicking things off with a massive market mystery that we're calling the Great Pizza Crash. Look, the recent data tells a pretty brutal story. Both of these industry giants have seen their stocks get absolutely crushed. Domino's is down 34% over a 5-year period, and Papa John's, well, they've practically collapsed, shedding a massive 65% of their value over that exact same time frame. Now, when industry leaders bleed this much, Wall Street usually leaves behind a golden turnaround play. But the real question is, which one of these is a coiled spring ready to bounce back, and which one is just a dangerous value trap? To figure that out, we put these two through a serious stress test. Here's our agenda for today. 1. The Great Pizza Crash. 2. Scale and operational efficiency. 3. The margin reality check. 4. The Dividend Danger Zone. And finally, 5. The final verdict. Let's get to it. Section 1. Scale and operational efficiency. First up, who commands the bigger slice of the pie? Right away, a massive gap emerges between these two. Domino's isn't just bigger, they are actively growing their slice. They've scaled their top-line revenue to nearly $4.94 billion in 2025. Meanwhile, Papa John's is just completely stagnant, hovering right around the $2.05 billion mark. So Domino's is generating roughly 2.4 times the top-line revenue of Papa John's, and in this industry, that scale creates a massive structural advantage. But hey, bringing in revenue is really only half the battle, right? We have to ask, how much does it actually cost to run the corporate machine? Because as any good business owner knows, bringing in the dough doesn't mean a thing if you're just burning it in the back office. When we look at selling, general, and administrative expenses, or SG&A, Domino spends more in absolute cash. They spend $464 million compared to Papa John's $244 million. But since we're looking for true efficiency, we know absolute dollars don't tell the whole story. We need to look at the percentage of revenue to see who is truly running a leaner business. And that brings us to our first major reality check. Domino's keeps their corporate overhead incredibly efficient, locked in at exactly 9.39% of their revenue. Papa John's, on the other hand, they suffered a really concerning spike in 2025, spending nearly 12% of their revenue, 11.89% to be exact, just to keep the corporate lights on. They are trending in the exact wrong direction, burning a higher percentage of their cash just to manage the business. Section 2, the margin reality check. Now, what's really interesting about this slide is what actually happens to the money once it comes in the door. Check out the dominance here. Domino's is pumping out an elite 21.4% EBITDA margin, which is just a measure of core operating profitability before things like interest and taxes. And when you flow that all the way down to the bottom line, Domino's is pulling in $601 million in clean net profit, with a fantastic 12.18% net margin. They are a highly efficient machine, turning dough into actual dollars. But contrast this sharply with Papa John's. Their EBITDA margin is a razor-thin 8.8%, and the net margin, it's a microscopic 1.49%. They only generated $30 million in net income. Just think about what that means in the real world. For every single dollar of pizza Papa John's sells, they get to keep less than a penny and a half. Summarizing this margin tale, it's pretty much a massacre. Domino's 21.4% EBITDA margin creates a powerful structural moat compared to Papa John's 8.8%. It proves definitively that commanding a bigger top-line revenue is only an advantage if your operations are lean enough to capture the profit, and Domino's is doing exactly that. Section 3, the Dividend Danger Zone. So we're moving from operational issues to a massive hidden danger for retail investors. Let me just pause and ask you directly. When you're looking at struggling stocks that pay a yield, what is the absolute biggest hidden risk for shareholders right now? Take a guess. It's 116.4%. Let that number sink in for a second. That right there is the urgent, blaring alarm for anyone holding Papa John's stock today. Let's define exactly what that means. We measure dividend safety by looking at the payout as a percentage of free cash flow. That is the percentage of a company's actual generated cash that gets paid out to shareholders. So the crucial point is that anything over 100% means a company is literally eating its own cash reserves or even taking on debt just to pay you a yield. And we all know cash is the lifeblood of any business. Contrast the absolute cash generated between these two. In 2025, Domino's printed a massive $671 million in pure free cash flow. That is real cash to buy back stock, invest in tech, or pay dividends. Papa John's is scraping the barrel, left with a paltry $52 million in free cash flow for the entire year. Domino's is a cash printer. Papa John's is barely treading water. And this brilliantly illustrates the glaring trap. Domino's highly secure 35.2% payout ratio leaves a massive buffer for future growth or unforeseen challenges. But stepping into Papa John's for its dividend, you were stepping right into the danger zone. That 116.4% payout is completely unsustainable. It's not a perk. It's a ticking time bomb and a glaring risk of an impending dividend cut, which, as we know, almost always triggers a massive collapse in the stock price. Section 4, the final investment verdict. Before we wrap this up and declare a winner, we have to address one last reality check on the balance sheet: debt leverage and capital efficiency. On paper, sure, Domino's carries way more absolute debt, over $5 billion compared to Papa John's $936 million. But debt isn't inherently bad if you can generate high returns on it. Domino's boasts an elite 18.6% return on invested capital. They are absolute masters at turning that debt into compounding profits. Papa John's has less debt, but their capital efficiency is an atrocious 6.1%, making their underlying balance sheet far more fragile. So let's summarize the final objective verdict based strictly on those 2021 to 2025 financial trends. When you look at revenue scale, margin power, SG&A efficiency, free cash flow generation, dividend safety, and return on invested capital, Domino's sweeps the board entirely. The numbers leave no room for debate. Domino's is the safe turnaround play, suffering right now only from a temporary sector multiple compression. Delivering the knockout punch here, Domino's is the clear buy. Papa John's is absolutely not a turnaround. It is a value trap with crashing margins, rising corporate overhead, and an entirely unsustainable payout. For us, it's a screaming avoid. I want to leave you with this provocative question. If you are buying a stock purely for its yield, what happens to your investment when the company inevitably runs out of cash to pay it? It's a stark reminder to always look under the hood and check the underlying fundamentals before you go chasing a dividend. Thanks so much for joining me on this explainer, and remember, keep questioning the numbers.